The markets are currently closed for the Thanksgiving holiday, but the financial machinery never truly stops turning. As of the last trading session, which concluded on Wednesday, November 27th, Supermicro Inc. closed at a price of 33.07 USD. That represents a daily movement of positive $0.24, or a gain of 0.73%. While a fraction of a percent might seem like a quiet bay for a stock that has been dominating headlines with double-digit swings, do not let that relatively flat close fool you. The tension underneath this price point is immense. Most investors looking at Supermicro right now see a company walking a tightrope over a canyon. The expectation is one of imminent peril. You have a delayed annual report, a resigned auditor, and the looming threat of being kicked off the Nasdaq exchange. The general consensus, if you read the fear-mongering headlines, is that this is a sinking ship that you should stay far away from. But here is where the reality might actually exceed that grim expectation in a way that forces us to pay attention. The reality is that despite the administrative chaos and the massive breach of trust with Wall Street, the actual underlying business, the machinery of building AI servers, is not only intact, but is arguably more critical to the artificial intelligence infrastructure build-out than it was 6 months ago. We are seeing a situation where the paperwork crisis is obscuring a hardware gold mine, and that disconnection creates one of the most volatile but potentially rewarding setups in the current market. When you look at the chart, you are seeing a battleground. The stock is down significantly from its highs earlier this year, where it was trading like the darling of the AI world, often mentioned in the same breath as Nvidia stock. Now it is trading at multiples that look incredibly cheap compared to its growth rate, provided, and this is the massive asterisk, that the numbers are real. The market is pricing in a high probability of severe failure, effectively treating the stock as if it is guilty until proven innocent. But recent developments, specifically the hiring of a new auditor and the filing of a compliance plan, suggest that the company is fighting back harder than the bears anticipated. This isn't a company rolling over. It is a company scrambling to fix its house while the factory floor is still running hot. Let's discuss what actually happened to cause this collapse, because you need to understand the mechanics of the fear to understand the potential for recovery. The catalyst was the resignation of Ernst & Young. When a Big Four accounting firm resigns and explicitly states they can no longer rely on the representations of management, it is essentially the corporate equivalent of a 5-alarm fire. It is not just a red flag, it is a siren. This caused a massive exodus of institutional capital. Funds that hold positions in safe managed portfolios, think of the conservative allocations in Fidelity Wealth Management accounts or Schwab Intelligent portfolios, are often mandated to sell instantly when governance risks hit this level. They don't ask questions, they just liquidate. That mechanical selling pressure crushed the stock price, driving it down to levels that attracted a very different kind of investor. Now we have the contrarian view emerging. The company appointed BDO USA as their new independent auditor. While BDO is not one of the Big Four, they are a top-tier global firm, widely respected and certainly capable of handling a company of this size. The mere fact that BDO accepted the engagement is a signal. Auditors are incredibly risk-averse. They do not take on clients if they believe there is active, unfixable fraud because it puts their own license and reputation at risk. BDO coming on board suggests that after their own preliminary due diligence, they saw a situation that was messy but manageable, rather than a crime scene. This development single-handedly put a floor under the stock price recently and sparked the rally we have seen leading up to the holiday. We need to talk about the business itself because it's easy to get lost in the accounting drama and forget what Supermicro actually does. They build the servers that power the internet, and more importantly, the AI models everyone is using. Unlike Apple stock, which relies on consumer gadgets, or Tesla stock, which is tied to consumer vehicles and autonomy promises, Supermicro is a pure pick-and-shovel play for the data center. They take the incredibly powerful, incredibly hot chips from companies like NVIDIA and AMD, and they package them into server racks that can actually operate without melting down. This brings us to their secret weapon: direct liquid cooling. As chips get faster, they get hotter. The new Blackwell chips from NVIDIA are absolute beasts in terms of power consumption and heat generation. Traditional air cooling, literally just blowing fans on the servers, is reaching its physical limit. You cannot blow enough air through a rack to cool these new dense clusters without sounding like a jet engine and using a small city's worth of electricity. Supermicro has been pushing liquid cooling technology for years, long before it was the industry standard. They have the manufacturing capacity to ship these liquid-cooled racks at a scale that competitors like Dell and HPE are struggling to match quickly. That is the reality that the market is ignoring. While the lawyers are arguing about filing deadlines, Supermicro is shipping racks. The recent movement in the stock reflects this tug of war. We saw a massive spike when the BDO news broke, followed by some profit-taking. This volatility is a paradise for active traders using platforms like Interactive Brokers Trading or the Robinhood app, where execution speed matters. But for the long-term believer or even the cautious observer, the question is whether the stock is a value trap or the sale of the century. If they manage to file their 10K and 10Q reports by the new February deadline, and if those reports show that the revenue growth is real, the re-rating could be violent to the upside. We are talking about a stock trading at a single-digit or low double-digit forward PE ratio in a sector where 30 or 40 times earnings is the norm. However, we have to acknowledge the bear case, because it's not just smoke, there is fire. The Hindenburg report that started this whole saga alleged channel stuffing, shipping products to customers who hadn't fully ordered them just to hit revenue targets, and related party transactions. These are serious accusations. If BDO goes through the books and finds that revenue was materially overstated, they might have to restate earnings for past years. Restatements are brutal. They destroy investor confidence and can lead to years of lawsuits. That is the risk you take if you buy right now. You are betting that the accounting irregularities are minor timing issues or process failures, not systemic fraud. For those of you watching this who use self-investing tools or manage your own individual brokerage accounts, you know that position sizing in a name like this is everything. This isn't a set-it-and-forget-it stock like you might find in a boring ETF in your Fidelity IRAs. This is a battleground stock. You have to be watching the news feed constantly. The recent 12% pop we saw earlier in the week was driven by pure relief, the relief that they have a plan. But a plan is not execution. The Nasdaq still has to accept the plan. If the Nasdaq rejects their timeline, delisting moves from a threat to a reality. Delisting would move the stock to the OTC markets, the pink sheets. While you can still trade there, liquidity dries up. Many big funds, like those managing Fidelity mutual funds or massive pension pots, are not allowed to hold stocks that are not on a major exchange. If delisting happens, they would be forced to sell whatever they have left, causing another massive flush in the price. That is the cliff edge we are standing next to. But again, look at the other side. If they stay listed, the shorts, who have piled into this name with massive leverage, will be forced to cover. A short squeeze on a stock with this much daily volume can send prices vertical in a matter of days. I want to pause here and ask you a question about your own positioning. Comment below how many shares of Supermicro Computer you currently hold, or if you're staying on the sidelines waiting for the auditor's signature. It's always fascinating to see where the retail sentiment actually sits versus what the institutions are doing. Let's broaden the scope to the ecosystem. Why does NVIDIA care? Jensen Huang, the CEO of NVIDIA, recently gave a shout-out to Supermicro. This was a critical moment. If NVIDIA had stayed silent, or worse, distanced themselves, it would have been a death knell. But NVIDIA needs Supermicro. They need every partner who can assemble these complex liquid-cooled systems to get their chips into the hands of Microsoft, Meta, and Google. The demand for AI infrastructure is so high that NVIDIA cannot afford to let a major partner fail if they can help it. This partnership is a safety net that many bears are underestimating. It is in NVIDIA's best interest for Supermicro to survive and keep shipping. We also have to consider the macroeconomic environment. We are in a strange moment where interest rates are high, but tech spending on AI is accelerating. Usually, high rates dampen capital expenditure, but the FOMO, or fear of missing out on AI, is so strong that companies are spending billions regardless of the cost of capital. This benefits Supermicro directly. They are the arms dealer in an arms race that shows no sign of slowing down. Even if the economy slows, the build-out of data centers seems to be the one area that is immune to budget cuts. If you are using investment help services or